All right, so let's jump right into it. We're talking about the PRA's near final rules for Basel 3.1. Remember all that chatter about the draft rules? Well, the PRA has been taking notes, and you've just released some pretty significant updates.
A lot to talk about, for sure.
So today we're going to unpack those key changes
Yeah.
and try to figure out, what they might mean for banks and the financial landscape. What do you think?
Yeah, there's a lot to unpack here. It's interesting, the PRA got a mountain of feedback on those draft rules,
Really?
126 formal responses,
Oh.
and over 70 stakeholder meetings. So it really goes to show how much attention these rules are getting.
Yeah, a lot of people paying attention for sure. So look, we're going to assume you're already familiar with the initial Basel 3.1 draft rules.
Right.
So this deep dive is all about understanding how those rules have changed based on all that feedback.
Right, so think of it as Basel 3.1, the remix, right? The PRA's main goals haven't changed, strengthening the UK financial system, staying aligned with those global standards, but they've clearly been listening to concerns and making adjustments.
Okay, well, let's start with the standardized approach then, where a lot of the action is. What are some of the big changes we're seeing there?
Well, one of the first things that jumps out is this new hierarchy for classifying exposures. It's all about consistency across firms. So now, instead of having some wiggle room, there's a clear order of precedence for how banks should categorize their exposures.
So let's choose your own adventure and more like follow the instructions.
Exactly. It might seem a bit rigid, but the idea is to ensure everyone on the same page when it comes to assessing risk. Transparency is key here.
Makes sense. Now, I know some institutions were breathing a sigh of relief when they saw the changes related to due diligence requirements.
Yeah,
What's going on there?
especially those dealing with certain multilateral development banks and international organizations. The PRA has exempted those exposures from some of the stricter due diligence requirements. It's a recognition that these entities often have pretty robust risk management practices already in place.
So less paperwork for those folks.
Exactly.
Now let's talk about credit conversion factors, huh?
Yeah.
Those always seem to be a hot topic. I see some interesting tweaks there, particularly when it comes to commitments.
Right. Remember, those credit conversion factors are all about, figuring out how much of a commitment a bank needs to treat as an actual on-balance sheet exposure for capital calculation purposes.
Right.
The PRA's gotten a lot more specific here. For example, for UK residential mortgage commitments, they've set the factor at 50%. They've actually crunched the numbers based on UK data and found that this is a more accurate reflection of the risk.
So a data-driven approach.
Yeah, data-driven.
I like that.
Yeah.
But what about other types of commitments? What's happening there?
Well, for other commitment type, they've actually lowered the factor from the initially proposed 50% down to 40%. Again, this is based on feedback and analysis, showing that the initial figure might have been a bit too high.
Okay, so fine-tuning based on real-world data. I like it. What about those exposures to public sector entities? Any noteworthy adjustments there?
Yeah, there's a key change for unrated central bank exposures. Now, banks can use the risk weight that corresponds to the central government of that country, the rationale. Well, central banks and governments are pretty intertwined, so their risk profiles are often similar.
Right, it's all connected. Now, one area that really got people talking was specialized lending, especially those infrastructure and SME support factors. A lot of folks were worried about what the final rules would say about those.
Yeah, this is where things get interesting. The PRA decided to go ahead and remove both the infrastructure and SME support factors from Pillar 1 calculations.
Whoa, so no more breaks for those sectors.
Well, not so fast. They've introduced something called firm-specific adjustments under Pillar 2A. The goal here is to prevent those capital increases that everyone was worried about, the ones that could discourage lending to these vital sectors.
So it's like a balancing act, keeping things safe, but also making sure those important projects still get funded.
Exactly. It's about finding that sweet spot where banks can support growth without taking on undue risk.
Right.
And speaking of supporting growth, there are also some important changes related to exposures to individuals and SMEs.
Ah, yes. Those always get a lot of attention. What's new there?
Well, one change that could be a win for SMEs is the removal of the 100% risk weight floor for certain SME exposures secured by commercial real estate. So in some cases, those loans could actually have lower risk weights than under the current rules.
Interesting. So potentially easier for small businesses to get the financing they need.
That's the hope. And to make things a bit easier for banks, they've also simplified the definition of SMEs. It's now based on accounting consolidation in the obligor's jurisdiction, which should streamline the assessment process.
Okay, simplification seems to be a recurring theme here. Anything else along those lines?
Definitely. The PRA is also streamlining how regulatory retail exposures are treated. They're aligning things more closely with the current approach under the Capital Requirements Regulation, or CRR. Now the focus is on the total amount owed, excluding all residential real estate exposures.
So less to calculate. That's got to be good news for someone.
Yes, it simplifies things for banks dealing with retail exposures. And undrawn commitments are now excluded from the calculation, which could provide some relief as well.
Okay, so less complexity is always a good thing. Now, we can't talk about banking regulations without mentioning real estate, right?
Right.
What's happening on the residential and commercial fronts?
On the residential side, there's good news for those self-build mortgages. The PRA has exempted them from the finished property requirement, allowing for a more flexible risk-weighting approach based on loan splitting.
So a bit more wiggle room there. What about those residential real estate exposures that are really, heavily dependent on cash flow?
Yeah, for those, the risk weighting is now more sensitive to the loan-to-value ratio. It makes sense, right?
Makes sense to me.
Higher LTV, higher risk.
Yep, yep. Now, commercial real estate's always a big one. What are we seeing there?
Well, the PRA decided to remove that 100% minimum risk weight in some specific scenarios. They're differentiating between SME and non-SME exposures and whether the loan's repayment is heavily dependent on the property's cash flow. There's actually a detailed table in the rules that breaks down the final risk weights for different types of commercial real estate exposures.
Okay, so definitely worth a closer look for anyone involved in commercial real estate lending. What I'm seeing here is a lot of fine-tuning, a lot more nuance in these rules.
You're catching on, and that continues with how they're treating equities. In the draft rules, there was this focus on venture capital exposures. That's gone now.
Interesting. So how are they determining risk for those types of investments now?
They've shifted to a focus on the age of the business, so businesses less than 5 years old will get hit with a 400% risk weight, regardless of whether they're considered venture capital or not.
Ah, so age equals risk in this case.
Exactly. It's a more objective measure than trying to define what qualifies as venture capital. Once a business hits that 5-year mark, the risk weight drops down to 250%, reflecting its increased maturity.
Okay, so that covers a lot of the key changes under the standardized approach, but what about the internal ratings-based approach, or IRB? Are there any major updates there that our listeners should be aware of?
Yeah, there are a few key things to highlight. For starters, the PRA clarified how SMEs are assessed against that size threshold. They're aligning things with the CRR approach, which simplifies the process.
Simplification again? Is there anything they didn't simplify?
Well, they did tighten the reins on IRB modeling in one key area.
Oh,
They're prohibiting banks from using IRB models for quasi-sovereign exposures. Those will now have to be risk-weighted under the standardized approach.
so more guardrails in place there.
Exactly. They want to ensure robustness and a level playing field. And remember those SME and infrastructure support factors we talked about earlier?
Yeah.
Well, the PRA is sticking to their decision to remove them from Pillar 1 calculations.
Right, but those firm-specific adjustments under Pillar 2A are still in play.
Exactly.
It's all about finding that balance, right?
Precisely. One more thing on IRB. The PRA decided not to go ahead with their proposed changes to the unrecognized exposure adjustment. They're keeping things as they are for now.
Okay, status quo on that front. Now let's move on to credit risk mitigation. Any big changes happening there?
A couple things worth noting. First, they're allowing firms to apply the Financial Collateral Comprehensive Method, or FCCM, to exposures on the slotting approach.
And remind me what FCCM is all about again.
It's a method for recognizing the risk mitigating effects of financial collateral. And the second key change is related to risk weight substitution. They've clarified that expected loss, or EL, won't be calculated for the guaranteed portion of an exposure.
Got it. So it affects how capital requirements are calculated when there's a guarantee involved. Now, we can't wrap this up and out talking about the output floor, can we? That was a big focus in the draft rules, and I know there's been a lot of discussion about it.
You're right, the output floor is a big deal, and the PRA has made a significant change here by introducing an output floor adjustment.
Okay, break that down for me. What exactly does that mean, and why is it important?
This adjustment is designed to better align the capital ratios calculated under the standardized and internal model approaches. It's all about ensuring a minimum level of capital adequacy regardless of which approach a bank uses.
So bridging the gap between the two approaches.
Exactly. They're doing this by incorporating the differences between expected loss, or EL, and accounting provisions into the calculation. It gets a bit technical, but essentially they've revised the output floor formula to include this new adjustment.
Okay, I'm sensing this one might need a bit more unpacking. Can you give me a concrete example of how this adjustment works in practice?
Sure, imagine a bank has provisions that exceed its expected loss.
Okay.
Under the new rules, that excess can be added to Tier 2 capital. On the flip side, if EL exceeds provisions, that difference can be deducted from CET1 capital.
So it's all about fine-tuning those calculations to get a more accurate picture of a bank's capital adequacy.
Precisely. By including these adjustments, the output floor better reflects the capital that would be required if all exposures were assessed using the standardized approach. It's a way of leveling the playing field and ensuring a minimum level of capital regardless of the approach a bank uses.
Okay. All right. Well, I think that's a good place to pause for now. We've covered a lot of ground here, from exposure classifications to credit conversion factors to the intricacies of the output floor. It's clear that the PRA has been listening to feedback and is taking a pretty measured approach to implementing these new rules. But this is just the start of our deep dive.
Yeah, it is a deep dive. And, we've gone through a lot of technical details, but I think it's important to kind of zoom out for a second and think about what all these changes really mean, for banks, for the financial system at large.
Yeah, okay, so let's zoom out then. What's the big picture here? How might these new rules actually play out in the real world?
Well, for banks, the first order of business is going to be, a lot of analysis. They'll need to dig into these near final rules and figure out exactly how they impact their operations.
Right, so a lot of homework for the banks.
Yeah, a lot of homework. They'll need to review their internal models, risk management processes, data collection, reporting systems, the whole nine yards. It's not just about ticking boxes on a checklist, right? They need to really understand the why behind these changes and make sure their practices are aligned.
Makes sense. But beyond the operational stuff, what about the potential impact on lending and capital requirements? That's got to be top of mind for a lot of banks.
Oh, absolutely. These changes to risk weights, credit conversion factors, the output floor calculation, they could all have a big impact on how much capital banks need to hold against different types of exposures.
And that, of course, could have ripple effects on, the cost and availability of credit.
Exactly. It's still early to say definitively what the overall impact will be, but it's something we need to watch closely. For instance, those changes we talked about to the risk weights for commercial real estate exposures, those could influence which projects get funded, right?
Oh, interesting. So some projects might get the green light while others get put on hold.
Potentially, yeah. And, the removal of those SME and infrastructure support factors, even with those mitigating firm-specific adjustments, could make lending to those sectors a bit more expensive.
So potentially higher interest rates for those borrowers.
Possibly, yeah. And that's why it's so important for everyone to really understand these changes. Banks, regulators, investors, even everyday consumers. We need to be aware of the potential consequences, both intended and unintended, so we can all navigate this evolving regulatory environment effectively.
Right. So knowledge is power in this case.
Absolutely. And that's where those Pillar 3 disclosures come in.
Oh, right, right.
Remember, Pillar 3 is all about transparency. It's about giving the market a clear view of how banks are managing their risks and complying with these new rules.
So it's not just about making internal changes, it's also about communicating those changes to the outside world.
Exactly. And with these near final rules, we can expect to see some updates to those Pillar 3 disclosures. Banks will need to provide more granular information about their exposure classifications, their risk weighting methodologies, how that output floor adjustment is impacting their capital ratios. The goal is to give investors and other stakeholders a really comprehensive and comparable picture of their risk profile.
So a deeper dive into the numbers, basically. Makes sense. Now, for our listeners who, want to really get into the weeds here, are there any specific sections of the PRA documentation that you'd recommend they check out?
Oh, absolutely. I definitely recommend taking a close look at the chapters on the standardized and IRB approaches. Those sections have all the nitty-gritty on those methodologies and how they're being updated. And for those who want to really get a handle on the output floor adjustment, that section is a must-read. It might be dense, but it's where the rubber meets the road in terms of capital adequacy.
Okay, noted. So before we move on, what's the one big takeaway you want our listeners to walk away with from all this? If they only remember one thing from this deep dive, what should it be?
I think the most important takeaway is this. These near final rules, they're a big step forward in making the UK financial system stronger, right? They're built on the lessons learned from the financial crisis, and they aim to make the banking sector more resilient and more transparent.
A safer system overall.
That's the goal, but it's not a one-size-fits-all approach. The PRA has clearly been listening to feedback, and they've tailored these rules to the specific characteristics of the UK financial system. It's about finding a balance, prudence and pragmatism, enhancing financial stability without stifling lending and economic growth.
Okay, yeah, that's a great point. So they're not just throwing the rule book at everyone.
Exactly. They're being thoughtful. They're being deliberate in their approach. Now, I know we've thrown a lot of information at you today, but I want to leave our listeners with something to think about, a question to spark further exploration.
Oh, I like it.
So here it is. How will these changes ultimately shape the financial landscape, both in the UK and globally?
Ooh, okay, that's a big question, but a good one. How do you think these rules might affect things beyond just, capital requirements and lending.
Yeah, that's the million-dollar question, isn't it? We've talked about those potential impacts, but the ripple effects could be much broader. How will these rules influence innovation in financial services? Will they lead to a convergence or divergence of regulatory approaches around the world? These are complex questions, with no easy answers, but they're worth exploring as we move into this new era of financial regulation.
Yeah, it feels like we're at a real turning point, huh? When it comes to financial regulation, I mean.
Yeah, I agree. It's not just about numbers on a spreadsheet anymore. These rules are actually shaping the whole structure of the financial system.
And it's not just about the UK, is it? These changes are part of a much bigger global trend towards greater transparency, greater resilience in finance.
Absolutely. Yeah. Remember those Basel Accords? They're international standards. So while each country kind of adapts them to their own situation, there's a shared commitment there to strengthen the global financial system as a whole.
Right, so what happens in London doesn't stay in London.
Exactly. It's all connected. And that's why it's so important to, stay informed. We need to understand the nuances of these changes and how they fit into the big picture. Because at the end of the day, these rules, they affect all of us,
Mhm.
whether they're investors, consumers, or just everyday people living in a globalized economy.
Okay, so final question for you. For our listeners who might be feeling, a little overwhelmed by all of this, what's your best piece of advice?
Don't panic. These rules are complex, but their purpose is really to make the financial system safer, more stable. The PRA is committed to transparency, so there's a ton of information out there to help you understand these changes. Don't be afraid to ask questions, dig a little deeper into the areas that matter most to you. Knowledge is power, right? The more we understand about these rules, the better equipped we'll all be to navigate this financial landscape and make smart decisions.
That's great advice. So on that note, I think it's time to wrap up this deep dive. We've covered a lot of ground today, but hopefully this has given you a clearer understanding of the PRA's near final rules for Basel 3.1 and why they're so important. This is really just the beginning of the conversation. Stay curious, keep exploring, and don't be afraid to dive deep into the world of financial regulation.